Welcome to the program, and I'd like to welcome my friends and colleagues, Jonathan Blotmacher and Robert Keebler. And we have what I think is a really important post-OBBBA topic, and it will change a lot of what we all do for lots of different clients, not all, but certainly many clients. And it will require that we kind of think a little bit differently, approach things a little differently, and we're going to get into all of that. I'm gonna just, unless you want to jump in, Jonathan, make a quick couple of comments for two of our sponsors, Interactive Legal. ILS provides really state-of-the-art software for drafting trusts. If you are still using your own internal forms, unless you're a really large firm that has a huge database of forms, make the transition to document generation software. Everything we're talking about can be drafted, and Jonathan, correct me if you feel differently, in many cases with a couple of clicks of a button in order to get you a really wide variety of the different types of trust to serve different client needs under the current environment. Post-OBBBA for very wealthy clients, you're going to probably want to focus still on completed gift trust to get assets out of the estate, because who knows what the future is. For many moderate wealth clients, you may want incomplete gift non-grantor trusts, and there's different options for how to do that, and so on. So the efficiencies and breadth of what you can do in your practice with document generation is huge, and ILS has an incredible array of options that can help you in this post-OBBBA environment. Peak Trust is our other sponsor, and Peak is a full-service trust company in Alaska with offices in Alaska and Nevada. I've personally worked with Peak and have had my own trust with them since 1998, and they've been incredibly responsive, very intelligent, and great to work with. And my view is that when you can use an institutional trustee, it's just a safer way to go for a whole variety of reasons. And without further ado, let's jump into the topic, and really let's talk about basis planning post-OBBBA. And Jonathan, don't get into the basics yet. We're going to come to that, but why don't you then, Bob, just make some general comments about why this is so important and what we're going to get into.
Well, Marty, one of my most brilliant colleagues at Millbank was Madeline Rivlin. And Madeline called me about 10 years ago and said, you know, with the estate tax exemptions being so large, in those days they were 5 million, she said, we really should be focusing on basis. And she said, let's write an article about that. So Madeline and I wrote an article which was in Estate Planning Magazine, which is a publication by the Journal of Taxation, called Searching for Basis in Estate Planning. Less tax for heirs. And it's a very good article, and I would urge you to get a copy and keep it. I think there'll be additional things that to what Marty and Bob and I are talking about today, which may help you better serve your clients.
Bob, I know you're excited about basis planning. I can tell.
With the $30 million married couple exemption, just step back and think about that. Especially in those states with no state estate tax, the emphasis is going to change to three things, Marty. Basis planning, which you're talking about today. Correlated with basis planning is all this phase-out planning, trying to get income off a 1040 to a 1041. But if you do that and it's a completed gift, no step up. If it's an incomplete gift, you can still get a step up. We're going to talk about that. And then the last area where lawyers are going to have to learn a little bit more on is this whole Roth conversion issue, which ties into the phase-out planning. But today we're here to talk about basis. Very exciting. The heart of it is, remember, if I die with something, there's a step up. If I give it away, there's a carryover basis. The question is, how do I get it off how do I get the income off of my income tax return onto a trust return and potentially have a step up in basis later? So how do we do that? How do we use general powers of appointment vested in older beneficiaries? There's just so much to dive into. And I think from the CPA's perspective, you have to be spotting these issues and finding first-class trust and estate attorneys that will help you draft these documents.
And
Bob, let me mention that this is not just a matter of having a great CPA for doing your tax return. This is going to cover pre-death planning. So it's not like, well, the clients will bring me the information and I'll do the best job I can on tax returns. You really have to be involved in the lifetime estate planning to try to get the benefits that Bob is talking about.
let me make two comments on what you both just said and then ask you a question before we go on. One, it seems to me in each OBBA, post-OBBA planning program we've done, and we've done a number on non-grantor trusts and other things and more to come, more than almost ever before, you really got to be very granular in your planning. What works for a client in a high tax state or doesn't work, like California, New York, may be different than for a client in a no or low tax state, Florida, for example. So you got to be very client specific in your planning. The second thing that concerns me, and by the way, apropos to your comment about CPAs, let me throw in wealth advisors. This is a huge, huge opportunity for wealth advisors. You don't want to get over your skis too far if you're not knowledgeable in some of these concepts. But boy, if you can just issue spot for a client and say, hey, you may have a planning opportunity here, you're going to be the hero. Because many, many clients, probably most clients, meet regularly with their wealth advisors and not with their CPAs and attorneys. So if you can issue spot, this is a great planning opportunity to add value for your client services. One of the things that concerns me, and just make a comment or two, Bob and Jonathan, if you wish as well, a lot of lawyers that are really skilled on the estate planning side may not be as strong as they on the income tax side to do some of what we're talking about. Just maybe comment on that, because I think it's important that people know what they know and know what they don't know so that they can do right by their client and not get in trouble. And some of this is complicated, a lot of it.
Well, I can take that very quickly. Most of the income tax planning has been done on the CPA side for the last 15, 20 years. At least I've seen it evolve. And part of that was the estate tax exemption. When the estate tax exemption was 600,000 and as it went to $1 million and kept going up, the lawyer was very focused on saving estate tax. That was the major issue. And now we're going through a transition where we can focus on the income tax. But when the lawyers I work with, when I explain what I want to achieve by getting income off of a 1040 onto a 1041, 75% of what they need to know is good, solid property law and trust law principles, Marty. This last 25% of the income tax, we can teach that in several hours of time. I mean, it's not hard if we break it down on a transaction by transaction basis.
Okay, so let's go on and look at the new world of post-OBBA planning. So obviously everyone knows there's a $15 million permanent exemption. That's going to make planning different, because for 99.75% only of the taxpayers, only about 0.25% of taxpayers face an estate tax based on these exemption amounts. And whether it's 0.2 or 0.3%, the point is few people face an estate tax. And that's something that we need to really address in how it affects estate planning, and especially basis planning. Jonathan, before we dig into some of the things that we're going to talk about under the new environment, can you give a little background on basis and some of the information that people need to understand so they understand what it is that we're doing? Because that'll sort of set the foundation or build the foundation for everything we then talk about.
Right. Well, Marty, if you go back to the 16th Amendment, which was enacted as part of the Constitution in 1913, there was a provision which said everything would basically get a stepped up basis to that date when the 16th Amendment became part of the United States law. And that's somewhat similar to what Canada did in 1973, when it decided that it was going to impose basically a gains tax whenever property was transferred, whether it was during lifetime, whether it was by gift, whether it was by sale. You make a transfer, including in Canada, to a revocable trust, you're going to have gain recognition. That's important because how much gain you have, and therefore normally how much tax you pay on that gain, is going to be determined by the difference between what you get or you're deemed to get when you transfer that asset away from you and its historic basis. And basis, of course, is determined, as I indicated, by either a fiat, as we had when we adopted the 16th Amendment, or by a law. As a general rule now, basis is determined by what you pay for the asset. So if I pay $1 million for a piece of property, that's going to be my basis, and that's going to affect the amount of gain or loss I experience when that asset is sold in a gain recognition event. It also will determine how much depreciation I get, because if you buy something for which the appreciation for tax purposes is allowed, you're permitted a deduction for that. Now that's very complicated. There are a variety of different rules, but basis is extremely important. Let me also mention that you might think, well, gee, Congress has been very, very generous having a $15 million exemption. Yes, it has been. And why do they continue to allow basis to be determined and stuff? Well, if you had no basis in it and you made a sale, you might have to pay tax on the entire amount, but you want a high basis to reduce the amount of tax that you will pay. So, and how is basis determined? Well, there are basically 3 ways, and that's under section 1012, 1013, and 1014 under the Internal Revenue Code. 1012 basically says your basis, in other words, the point from which you determine how much tax you pay upon a taxable disposition, or the amount of depreciation you can take, is going to be based upon what you pay for it. It's called purchased basis. That's 1012. And there are a lot of exceptions and special rules, but that's it. The second one is 1014, which is, basically an inherited property, where as a general rule, section 1014A says your basis is equal to the fair market value of the property at the time of death. Now, we're going to talk about some of the exceptions and special rules that are there, but that's it. And the final one is 1015. I said 13, but I was wrong. It's 1015, which is a carryover basis as a general rule for assets which are gifted during lifetime. So if I have an asset that I paid $1 million for and my basis has remained $1 million and I give it away, as a general rule, but subject to exceptions, the person who receives that from me, whether it's my wife, whether it's my kids, whether it's my cat, they will take over my basis, this carryover basis. So 1012 again is purchase basis. 1014 is basically, you could call it inherited basis, where usually it's going to be equal to the fair market value at the time of death. And 1015 is basis which you get when someone has given it to you.
Bob, any comments, elaborations?
No, that was perfect explanation. The IRD is kind of an exception. For example, IRAs, the interest on U.S. savings bonds, interest accrued at death does not receive a step up. So there's special planning there. And generally, when we talk about making gifts, keep in mind, we've not been able to figure out a way to give away your IRA. I tried to get a ruling on that a long time ago, 15 years ago, under the grantor trust theory, and the government basically said under the anti-alienation rule, you couldn't give away your IRA. So we're dealing with property that would, when we look at something to gift away, typically something that would receive a step up in basis at death.
Let me mention that Bob did try to get a ruling. There is a strong indication in some private letter rulings, which of course are not binding precedent upon taxpayers or the government, but there is a strong indication that you can transfer an IRA if permitted during lifetime. That anti-alienation rule that Bob mentioned applies to pension plans, but it does not necessarily apply to IRAs. But the government didn't like that. Now, the brilliant Natalie Choate, who writes the leading book on estate planning with respect to qualified plans and IRAs, she and I discussed this many times. And I said, well, Natalie, I think that under the IRS's own position, as reflected in Revenue Ruling 85-13, you can go ahead and basically say that, well, yes, there is going to be a basis carryover on it, but if you have a grantor trust, then you have the grantor still owning the asset. If you take a look at the regulations under 1001 example 5, I think it's 1000, actually I think it's example 1-2 subdivision E example 5, you will see that the IRS explicitly says that the grantor of assets in a grantor trust continues to be treated as the owner of those for all income tax purposes. So the theory, and Bob tried to get a ruling on this, hey, you guys are saying it's your official position. It's not just 85-13, it's now in the regulations, which clearly have the force of law. You've gone ahead and said that the grantor still owns them. Well, if the grantor still owns them, why can't I transfer my IRA to a grantor trust? And maybe I can do some estate planning with respect to that. Well, Bob tried to get a ruling to clarify that, and the IRS said, we're not going to rule. Natalie called the IRS, and they said, well, we have an internal dispute in the Internal Revenue Service. The income tax people say, yes, that's our official position, as reflected in 85-13 and example 5 under the 1001-2 regulations. That's very true. But the people who really care most about pension plans feel that's an abuse and we shouldn't let you do it. And that means in your planning, the very worst asset you can have is one which has an IRA in your hands or a qualified plan, because the inherent gain represents income in respect of a decedent. And there is no tax-free step-up in basis under section 1014, I think it's subdivision C, for the right to income in respect of a decedent, like your interest in a non-Roth IRA or a regular pension plan. Now, there are some old historic exceptions and special rules which come up from time to time. But as a general matter, if you have an IRA or a pension plan, it's going to represent income in respect of a decedent, and 1014 C says there is no tax-free step-up in basis, which means that when you inherit something like an IRA that's not a Roth or a qualified plan, you're going to have a very low basis, and it's possible you will face both estate tax and income tax. And if you're in the wrong state, let's say the decedent died in Washington state, where I think the estate tax rate now can get as high as something like 30%, Bob?
Yes.
Yeah,
Yes.
I mean, 30%, wow. Plus, let's say your client who's going to inherit this is in a high tax state like California, they're going to pay a very high income tax. And the effective rate of taxation can approach 100%. Very, very scary. But it's very tough to do any planning, because the IRS said, hey, if you try to transfer this, even to a grantor trust, we are going to go ahead and say you recognize the inherent gain there, and you will not get any sort of increase in basis. So that's very important for planning with respect to qualified plans and IRAs.
Let me ask Bob a question, and then I'm going to flip it to Jonathan with another question. So 2 questions. First question for Bob. Under OBBBA, we have some incredibly valuable tax breaks. Depreciation, 100% bonus depreciation. I'm going to use the incorrect term. You can correct me. The production facility, if you have a qualified production facility, I think you can write everything off in year 1. So we could have somebody that takes those big deductions that OBBBA has enacted. Their basis in that asset is now 0. But if we make sure we keep it in their estate, at least for estate tax purposes, there's going to be a huge step up.
Unless it represents the right to income in respect of a decedent.
You're both right. And couple of considerations. First of all, let's just say you have a gentleman, he's 80, okay? I just spoke to a gentleman the other day. He's 80 years old and he's building a new factory. And through an LLC. That write-off is going to cause a big loss. And part of our thinking is maybe we put that in a non-grantor trust with one of his sons as a trustee, material participation, sons in the business, and then that loss would not be lost when he dies. Marty, if the 80-year-old gentleman we create a $20 million loss on his return, and he dies with a $15 million loss carry forward, that loss carry forward disappears. So some of the planning here has to be, this is really good for lawyers to think about. If somebody's going to have losses, do we want to get those losses on a non-grantor return instead of on the person's personal return or on in a grantor trust return? So there's a lot here, but you're exactly right. No one's really talking about this yet, but the new depreciation, bonus depreciation,
R&D write-offs,
R&D write-offs, there'll be folks out there with losses, and those losses will die with them. And so we have to figure out, do we want to get those losses off of their income statement, if you will, onto a trust income statement?
and what happens to the NOL or the loss carry forwards on the non-grantor trust, just to complete the thought?
On the non-grantor trust, it survives. It doesn't disappear. That's a separate legal entity for tax purposes.
Big planning opportunity. And again, this is
let me mention that I once almost arranged for someone to marry another person who died with a huge loss, and we were going to take the big loss of her final return, but we had a guy who wanted to marry her so he could file a joint return. It would be her final return, and he could take the loss. Never happened, but it's an interesting thought, Bob. Perhaps you have some clients in Wisconsin where that would be acceptable.
Most likely not, but I'll look for that person.
Jonathan, let me ask you a question, because this to me is very significant, and it needs to really be thought about. And at minimum, I would suggest that practitioners bring this to the attention of clients, probably in writing. If you want to unwind some planning, and we're going to talk about it, to get assets back in the estate or do an incomplete gift trust to keep assets in the estate, we know we have a $15 million, air quotes, permanent exemption. How confident are you that that permanent exemption is going to be here in 10 or 20 years?
Well, Marty, I don't think you can be confident at all, because if you have another regime come in or administration come in, they might say, hey, let's do it. Now, by the way, you might keep in mind that, again, people think, oh, the Congress has been very generous giving us a $15 million exemption. Why didn't they just completely eliminate the exemption? And here's the deal, and it's a very important one. Even if you don't pay a state tax because you're under the exemption or for any other reason, you still get the income tax-free step-up in basis. This is nirvana. You can have someone who has $2 billion, $100 billion, and she dies. And if she leaves it to her husband, for example, under the protection of the marital deduction, there's not going to be a penny of estate tax paid, and yet the inheriting spouse, or if it goes through a marital deduction trust, will get that automatic change in basis under Section 1014. Back in 2010, when they said, hey, you don't have to pay estate tax, you can elect basically out of the estate tax system, they had a carryover basis. So most people, I think George and Steinbrenner may have been one who owned the Yankees, he didn't have a spouse to avoid the estate tax. So he said, I'm just not going to pay estate tax, and we'll try to do some things during lifetime. But he didn't pay estate tax. But if you're, if you're wealthy like Marty is, and you die and you have the property go anywhere you want, yes, you can have up to $15 million. If you're married, you can have up to $30 million, and yet you're going to get a stepped up basis on the whole thing. Not the income in respect of a decedent, but everything else. Now, that's a great deal because, as Marty said, over 99% of the people are going to be way under that $15 million exemption deal. So for them, the fact that there is a potential of estate tax if their estates get too big isn't going to take away from the stepped up basis. It's extraordinary what that's done. So if you're a wealthy person, you probably say, hey, I'm willing to pay a little bit of estate tax in order to get that stepped up basis. That's a very, very good deal. Now, I think in Washington, someday somebody is going to realize what a super deal this is, and they might be better off repealing the entire estate tax, which they've done for over 99% of the people, and basically have a carryover basis system rather than having a stepped up basis. Because again, even if you don't pay a penny in estate tax, you nonetheless get the tax-free step up in basis if the assets are includable in the gross estate. You don't have to do any special planning at all. It's just a phenomenal deal.
Let me just quickly finish the points on slide 14, because these are things to keep in mind. As we just discussed, there's no assurance that even though the exemption is permanent, that a future administration will lower it, or as Jonathan said, they may repeal the estate tax. We may have a capital gains on death. We went through all sorts of iterations in various proposals in 2020, 2021. The Democrats have continued to propose all sorts of changes to make the estate tax harsher. Any of those may be enacted. So keep that in mind before you unravel the protections of a trust that has assets out of the estate just to get a basis step up. And obviously consider risks of lawsuits, claims, Medicaid, divorce, the liability of fiduciaries. If you're unraveling a trust and you're the trustee, what do you have to do to get approval from the various beneficiaries? You don't want to have the liability exposure if something happens. Let's change gears and talk about a really important topic. And I'm sure some advisors are grappling with this. A lot of people have not done a lot with incomplete gift trusts, but that's something that the dynamic for a lot of clients has changed. And keep in mind as we go through this is great planning, not just for really wealthy clients, but even for moderate income clients. So Bob, we have this new dynamic, but start with the foundation. Why would I want to do an incomplete gift trust? What's the consequence of that versus a completed gift trust? Grantor versus non-grantor. There's really several different options and different results from different structures. Why don't you give some background on this and let's talk about it.
The first place to start is under OBBBA, there are new limitations in the law which create about 8 different phase outs. Now, most of those phase outs are somewhat pedestrian, but there's a couple of them that are worth talking about. If Marty, if you and your wife earn exactly $500,000, your SALT deduction is $40,000. But if you earn $600,000, your SALT deduction goes to 10. Now, so that journey from 500 to 600 causes your income to go up by $130,000, which essentially is an effective tax rate of 45.5% federal. Okay. Now, why is that important? Because if Jonathan drafts a trust for you, basically a non-grantor trust, and you transfer property into that trust, we've taken income off of your financial statement, your income tax return, and shifted it to the trust's income tax return. And if we did that to the tune of $100,000, we basically would save that SALT deduction, okay? So you would get your SALT deduction back and the trust would get its own SALT deduction.
And Bob, is the SALT deduction for a trust the same as it is for an individual up to 40,000?
That's what the statutes say, Jonathan. Everybody agrees with that. There's no carve out or differential. And people are concerned that let's say you had 2 young doctors who wanted to get married and they're, separately, they're each making $499,000. They each get their $40,000 SALT. They get married, they lose that SALT deduction. So there's some discrimination in there that Congress, people are calling on Congress to deal with that.
Yes,
Do they?
it's the marriage penalty, the marriage tax penalty. Now, normally the government wants people to be married for a variety of reasons, but the way that the income tax has been structured over about the last 30 years, you are actually hurt if you get married. So, especially if you're both making about the same amount of money. Now, if you've got, a big income tax earner like Bob who makes 5 million a year and his wife doesn't have any sort of income on her own, they may be better off from a tax perspective being married. But if you're in a situation where each spouse makes about the same amount of money, as Bob's example, 2 doctors or 2 lawyers or 2 Indian chiefs who have about the same income, they will be hurt financially in a tax sense if they get married.
My wife and I just renewed our vows at the Chapel of Love in Las Vegas, and there's a big warning sign post-OBBBA outside of the chapel that says, your marriage may be detrimental to your tax status. So, yes, it's well recognized. Bob, just to clarify in case somebody misunderstood, you're not moving, and I know you meant this, but maybe I didn't hear it right, so forgive me if you did, but you're not moving the 100 grand of income to a 1041, a non-grantor trust return. You're moving the assets by gift into the trust, and then because the assets are in the trust, the income will be in that trust and realized by the trust.
Right. To paraphrase Leonard Hand, you're moving the tree and the fruit follows.
And Bob, maybe you can clarify. So now I move this income off my return. What does this have to do with estate planning?
Well,
that's a segue into complete and incomplete.
Right. No. Let's just say you did that with treasury bonds, where your basis is somewhere between 98 and 102% of fair market value. No problem, right? That's easy. But Marty, what if you had purchased a dividend producing stock 25, 30 years ago, and you're getting a 5% dividend on that? You'd want to transfer it to save income tax while you're alive, but you'd say, wait a minute, you're not going to get a step up in basis if you use a completed gift trust because it's out of your estate. So at that point in time, we could pivot to an incomplete gift trust. And if that trust is drafted correctly, what's going to happen is you have an incomplete gift for federal estate tax purposes. The property will be included in your estate when you die. And because it's included in your estate, you're within the reach of the income tax provisions of Section 1041, which Jonathan mentioned earlier.
1014,
I'm sorry, 1014, which give you a step up in basis. So the beauty of this is you can really have, to quote your slide earlier, you can have your cake and eat it too. So I can get the income off of my lifetime return onto a trust return and then receive a step up in basis on it later when I die.
So just to repeat, because this is so fundamental and important, if you want to do income tax planning post-OBBBA, let's just use the SALT deduction because that kind of income tax planning is not our focus today, but it's all interrelated, which Bob is pointing out. If I can shift assets that produce 100 grand of income off my personal return, my 1040, onto a complex trust, non-grantor trust 1041 return, and those assets produce 100 grand. If I was making 500 grand in salary, 100 grand of passive income, my income is now down to 500 on my personal return. I get my full 40 grand SALT deduction, so it's a 30 grand incremental deduction, and I've shifted the 100 grand of income to this non-grantor trust return. But the price to pay with more typical completed gift trust planning is now it's outside of my estate. I don't get a basis step up. If your client is worth or may be worth more than the exemption amounts, then that still makes sense. But for the vast majority of taxpayers, they're never going to be worth anywhere near a $15 million exemption, let alone $30 million exemption. For those taxpayers, maybe the non-grantor trust should be structured as an incomplete gift trust. That means that for estate tax purposes, it's included in my estate, but I still got the income tax benefit. So that's why you're having your cake and eating it too. Jonathan, can you comment on a couple of things? One, how do I make this trust an incomplete non-grantor trust? And what does that mean in California and New York?
Well, let's go back to what is a complete and incomplete gift, because again, if your gift is incomplete, it's going to be includable in your gross estate, and you're definitely going to get a step up in basis unless the asset represents something like the right to income of the decedent, like an interest in a pension plan. And I mean, that's it. And if you take a look at regulation 25.2511-1 and what follows, 25.2511, you will have a complete discussion of what constitutes a completed gift and what doesn't. Normally, people do not want completed gifts because it means that they're going to have to either use gift tax exemption or they're going to have to pay gift tax on it. And the rules are quite clear as to when you have a completed gift. Now, by the way, it doesn't mean that you have to give up the ownership. If I create a trust, for example, for my two sons, and I retain the power to determine which of them will get the property in that trust, even though I can't get it back myself, that gift is incomplete. That comes out of a very famous Supreme Court case decided in the 1920s, but it's something that you can use today, but you can take a look at those. But you can have a trust, for example, where you are entitled or eligible to receive the income. And yet, even if you don't receive the income, if no one else can receive the income during your lifetime, and you can control where it goes when you die, that is regarded as an incomplete gift for gift tax purposes, and that will put it in your estate. That's the general rule. So that's kind of a bad thing if you want to get it out of your estate. You think, well, I've given it up, I can't get it back. But the fact that you can control where it ultimately goes, that causes it to be a completed gift. And maybe you don't want that because you're going to have to pay gift tax on it. What the IRS has issued almost 100 rulings on trusts that were regarded as incomplete for gift tax purposes. So you weren't using any of your lifetime or testamentary gift and estate tax exemption, and yet were not regarded as incomplete. So you could have your cake and kind of eat it too. There are about 100 of them. I've written extensively about it with Marty and with Bill Lipkin, and it's something perhaps you want to look at. The IRS had issued, as I said, nearly 100 private letter rulings approving that. Yes, you can create a trust, and it won't be a completed gift, so you're not using exemption, and yet it's not going to be subject to income tax because it's not a grantor trust. They're called incomplete non-grantor trusts, and the IRS issued many. However, about 3 years ago, the IRS said, even though we've issued all these rulings, we're not going to issue any new rulings. By the way, you're not saving anything from a federal tax perspective by doing that, but you can avoid state income tax and state gift tax by doing that. So people began to do that by the bushel, and the IRS finally said, I think it may have been from pressure from the estate and some academics who said, no, you can't do that. You can't do a trust which is an incomplete gift and yet is not a grantor trust. Now, the reason, if you get into the details, and we could spend days on this, what constitutes
That sounds exciting, Jonathan.
Yes, what constitutes a grantor trust? Very complicated area. There are some articles on that, some of which Marty and I have been involved in drafting, which talk about how to do that. But now people don't do it. But it's not to avoid federal tax. It's to avoid state income tax.
Bob, any other comments? And then I'll summarize because this is like very important.
No, I think if you step back and think about it, there are several ways that I can get property from an income tax perspective. I can move the tree into a trust, if you will, and then the fruit will be taxed to the trust. And the question is, how do I get a step up in basis on that later? What we're talking about now is the use of the incomplete gift trust. And when we march through this material, I could also do the same thing with a slant and give my wife.
What is a slant, Bob?
Spousal lifetime access non-grantor trust. And potentially, if drafted correctly, I can give my wife a general power of appointment over that when she dies to the extent she has remaining exemption. So there's a couple ways to approach this problem. But what you need to know right now is that you can have your cake and eat it too. You can get income off your return and still receive a step up in basis on that property.
Just to summarize, because I think this is so very important, post-OBBBA, a lot more planning for a lot of clients, and not just uber wealthy clients, but client of far more moderate income or assets, is going to be centered on creating non-grantor trusts to qualify for a lot of the OBBBA tax benefits that have phase outs. We've used only SALT deduction as one to illustrate, because our topic is basis today, not non-grantor trust planning. In the creation and planning for a non-grantor trust, you as an advisor need to evaluate, should it be a completed gift? Because gee, the client's really wealthy and their estate's going to grow well beyond the estate tax exemption, or I'm really worried that a future administration is going to lower the estate tax exemption even though it's now permanent. And in contrast to that, should I instead make that non-grantor trust an incomplete gift, because that way I can get inclusion in the settler's estate and a basis step up. So non-grantor to get better income tax benefits post-OBBBA, and then incomplete gift to get a basis as well. So a lot of partners have grown with all different decisions in the intersection of them and how it relates to income tax planning post-OBBBA. But I think, and Bob, correct me, Jonathan, correct me if you feel I'm wrong, I think these are pretty fundamental concepts that advisors that are doing irrevocable trust planning for clients or doing income or estate planning for clients need to understand. And if you guys are good, we'll go on.
Go on, Marty.
Let's go, Marty.
Okay. So let me talk about downstream planning. Everybody knows about upstream.
No, but Marty, explain what upstream and downstream planning are for me. I'm not sure I know what those are.
You know everything, Jonathan, but it's a good question for the audience. I will do so. Downstream planning appears way later in our outline. If we get to it, we'll let Jonathan and Bob talk about it. Upstream planning is where I give a general power of appointment to, say, an elderly parent, aunt, or somebody else who's got a modest estate, and that causes the assets in an irrevocable trust I created to be included in their estate to get a basis step up on their death. We're going to come to that later, time permitting. What is downstream planning? It's a different concept that we've all looked at as tax attorneys. I looked at it as an accountant doing income tax planning long ago, but the new tax paradigm, if you will, of OBBBA makes this ever more powerful. So I have a family business or a rental property I'm going to sell, and I'm going to get a large gain. Well, you know what? I'm going to be taxed at the maximum bracket. I got a bunch of kids that are over the age of the kiddie tax applying, so they're in their own tax brackets, but they're still young and they're just starting out and don't have high income. If I take and give each child, and it could be a trust for the child, we'll come to that, but if I give each child 10%, some percentage of this asset before I sell it, so that when we sell it, and there can't be a contract in place, you can't have a deal done, you don't want an assignment of income issue. But if I make a gift to a child of an ownership interest in this, let's say, LLC that owns this asset, and then when it's sold, they get that percentage of the income, they're going to be in a lower bracket than me for federal tax purposes. They may even be in a lower tax state. I'm in New York. I think New York is the highest tax state, although it seems like New York and California are in competition with each other to see who has the highest tax rates. But you can save state income tax and get a lower federal income tax by shifting, I'll use Bob's analogy because it's great, shifting part of the tree to the child, so the gain on selling the tree will be taxed to them. Now, in the past, one of the impediments to that has always been the gift tax. Historically, one of the reasons for enacting a gift tax was to backstop the income tax, specifically to prevent what I just said. Because if I gave a gift to my kids and the exemption was only 600 grand, I'd use up that exemption and then I wouldn't have any exemption for planning my estate. But over 99% of the population will never face an estate tax. Now, I wouldn't do this for somebody that's got a $12 million estate without really thinking carefully. But if a client's got a $5 or a $10 million aggregate estate, why not use some of that exemption, even if it's wasted and lost, giving a gift to the kids and letting them realize the lower capital gains? Why don't I let you guys comment on that, and then we can talk about using a trust that's grantor perhaps to the kids. Bob, Jonathan, comments on downstream planning?
Well, I'll give you a great example. Let's say you have a child who is in, they're just out of school, they're 23, 24 years old, and you decide that you give them money so they can sell some stock to pay off a student loan.
Great.
You should be able to avoid the kiddie tax. You gift it to them, and then say a month later they sell. And I don't know how many. You probably don't have to build in a month, but I'd build in a month, and they just sell the stock. Call it Apple or Nvidia. So that's what they're going to do. Keep in mind, if their income is low enough, they'll be in a 0% capital gain rate. And even at the next bracket, they're only in a 15% rate, where the parents are probably in a 23.8% rate. And the place to really use this is when somebody has a concentrated position, Marty. In other words, the parents come to see you and 40% of their net worth is in one stock. They can move some of that to their children, let their children sell it, shift the income to the children's returns, and make their portfolio a little bit more diversified.
Now, one of the things you want to keep in mind is that some people will say, yeah, but I don't feel I'm wealthy enough, because Marty has said you can only do this if you're not uber wealthy like Bob and Marty are, in order to get the income tax at the kids bracket. So if I give all this stock, I take my NVIDIA stock and I give them $3 or $4 million of my NVIDIA stock, I might feel I really can't afford to do that because I may have needs at a later time. And that's when doing a non-grantor trust may come into play. So you create a non-grantor trust, and indeed you can go to a lot of states like Alaska, Nevada, Delaware, South Dakota, and create a trust of which you are a beneficiary, but it's not going to be a grantor trust. And we can talk about how you can do that so that the trust is a separate and independent taxpayer, and you can have the trust's income either taxed to the trust or shifted over to your children who are in lower brackets. So the kids will have to pick up the income, but not necessarily wind up owning the asset, which may be contrary to what you want for later in your life.
Let me make a couple of comments, because I think there's some really valuable opportunities here. This can be done for a client that's not shifting $2 or $3 million per kid. It could be done cost effectively for a client that wants to shift a few $100,000 per kid. So it doesn't have to only be for very high income or very wealthy clients. It can be for other clients as well. And this is a way that wealth advisors and accountants can take valuable planning ideas to clients that may have not had these ideas before. So think about a much broader wealth and income spectrum for this planning. Jonathan, let's say I don't want to put the money in my kid's name, but I want the kid to pay tax on it instead of using a non-grantor trust. What if I set up a trust and the kid has a crummy power to withdraw? Doesn't that make the trust a grantor trust as to the kid, so that perhaps that trust can buy the asset?
So the trust can buy the
Or
asset?
use a 678 power to make the income taxable to the kid?
Yes, Section 678 says if a beneficiary has a unilateral right to withdraw property from a trust, that beneficiary is now the owner of the assets in the trust. And one possibility, which we've kind of discussed among Bob and Marty and me, is basically having a trust where it says that the beneficiary can withdraw a percentage of the taxable income. And will that work to shift that income over to the kid? Now, the kid can take it out, and you might want to worry about that, but you can cut off the child's right to withdraw the property. Now, normally, if you lose your right to withdraw the property and it exceeds the greater of 5% of what's in the trust, or $5,000, now the kid will have made a gift. But you can give the kid sufficient power so that the gift by the kid will be incomplete. So you can get it into a trust, where the trust recognizes it. It's not going to be a grantor trust with respect to the grantor, but it will be a grantor trust with respect to the child, and the child therefore can report the income.
Any other comments on downstream planning?
I just think this is a big opportunity, and for the lawyers, take a little bit of time, learn how the kiddie tax works, because you really can't use this for people that are certainly still in high school, probably still in college, okay? But once you get beyond that college, you can use this.
The reason is that the federal government basically says that the kid, even though it's his or her income, it's going to be taxed at the parent's rate of tax. So you're not going to save anything. That's the so-called kiddie tax. But you can go ahead and structure it so if you have an older child, that can be attributed to the child. For example, someone is in, graduate school or something, or just married, or lives in a lower jurisdiction. For example, maybe they live in Florida as opposed to where the family is, which might be California or New York, as Marty said. But there is a real opportunity for kind of middle-class families to reduce their overall income tax by having the income attributed to the kid. Again, you've got to start by putting it in trust. You can't just give it to the kid, because the kid might decide that having a Maserati or going on a whirlwind vacation throughout the world for the next 3 years with her boyfriend is better than keeping that money for safekeeping in the future. So you've got to always consider trust as a way to do this, but you can get it shifted, the tax on it shifted to the kid who's going to be in a lower bracket, and yet not make it the kid's money, including not making it the kid's money for tax purposes or for creditor purposes. Because maybe, you put this in trust for your kid and you give the kid a unilateral power to withdraw the property for the trust. That's a general power of appointment. And under the law of almost all states, if someone holds a general power of appointment, that subjects that property to the claims of his or her creditors. There is at least one exception, and that's in the state of Alaska. If I create a trust for my son and I give my son a general power of appointment, and he does not exercise it, it will not cause it to be subject to the claims of his or her creditors. And that's something very important to consider when you're talking about these techniques.
Let me break out what we just said into a couple of categories. So if you have a more wealthy client where the assets to be transferred, the tree with the fruit per bob, you may use a trust, a 678 trust that's grantors to the child. And because the number is large enough, you may put that in Alaska to get the asset protection that Jonathan just spoke about. If you have adult children, like Bob illustrated, either putting it in their own name if the client, it's not a lot of money, or setting up a grantor trust for that child in the home state may be a perfectly reasonable planning opportunity. If you have a child that's still subject to the kiddie tax, you're not going to accomplish anything by moving the tree with the fruit to the child before a sale. But in that case, you use a non-grantor or several non-grantor trusts. So let's move on from downstream planning, which I think is another interesting planning opportunity. And Jonathan, your name is all over this topic, so I'm going to just cede it to you. What is a community property trust, an opt-in community property trust? Tell us all about it, and why is that relevant to basis planning post-OBBBA?
Well, Marty, I could spend a couple of days talking about the history of community property and the federal tax system. But basically, a community property state, and historically there were 8 of them, from Louisiana, Texas, New Mexico, Arizona, Nevada, Washington State, Idaho, were the original community property states. Wisconsin in the 1980s adopted it by legislation, and yet the IRS has ruled that, yes, if you create this kind of property automatically under state law between spouses, it will be community property. And since I began to practice, I have been very jealous of having community property, because for historic reasons, and again, we could spend quite a bit of more time on this, but I won't go into it in detail. Section 1014B6 says, even though the decedent didn't own an interest in the property and it's not in his or her estate, we will nonetheless allow the assets owned by the spouse, which represent his or her half of community property, to have that income tax-free step up in basis. So for example, if you have a couple in California and the husband dies, his half of the community property is going to be includable in his estate. And depending upon his exemption and where he lives it, because he has pretty free reign as to what to do with that, it may be subject to estate tax. However, it doesn't have, but there'll be a stepped up basis. But what about his spouse's half? Well, 1014B6 says the surviving spouse's half of the community property, even though the decedent didn't own it, even though the decedent couldn't control it, we're going to give a tax-free step up in basis at that. And 6 different times I went up to Albany begging our New York legislators to please allow people in New York to adopt in community property by an elect-in system. All the original states I mentioned and Wisconsin basically have an opt-out system. If you get married in that state and you stay in that state, virtually everything that either spouse acquires is going to constitute community property, and you get the basis step up on each half of the community when the first spouse dies. But those are opt-out systems. And I said, well, maybe you can get it even if it's an opt-in system. And indeed, there are a number of places in the world. Believe it or not, Belgium is one. Belgium is one. Sweden is one, Germany is one, where even though you may start with a separate property regime, as we have in the vast majority of these states, you can elect into community property. And indeed, let's say you have a couple that grew up in, let's say, New Jersey, and they move to California. Well, their property doesn't automatically transmute into community property, so you get that double step up in basis when the first spouse dies. But California allows spouses to elect into community property, and if you ask any California, Nevada, Idaho, lawyer, they will tell you that if you elect into community property, even though you didn't start there, you nonetheless get the tax-free step up in basis. So I tried to convince the New York legislature to pass a law which would allow a couple in New York to elect into a community property system. But the New York legislators who were male said, Jonathan, we know we're just trying to get more property over to our wives, and we're against that. We want it for ourselves. So it didn't happen. But it's such a great deal that with my brother, we went to the state of Alaska and said, why don't you allow Alaskans to have an opt-in community property system? They'll have their same historic separate property system, but if they want to, they can elect in. Well, that was fine for people in Alaska, and virtually every couple in Alaska is going to go ahead and elect into their community property system. But I said, suppose we provided that people who don't live in Alaska can elect into Alaska community property and therefore get that double step up in basis. Well, again, there are cases out there, one of the most significant of which is called Angerhofer, Angerhofer, Angerhofer versus Commissioner. It's a 1986 tax court decision, which basically strongly indicates, and there are a number of other cases, including the Westerfall case, and a case involving a couple actually from Uganda, which basically says, yes, if you elect into community property, it will be treated as community property for federal tax purposes. And indeed, when you take a look at section 1014B6, and Marty, I don't think you can bring it up fast enough for us to look at it, but it just says, if the property is community property under state law, and if the couple can elect for it to be there, and then it's going to get that tax-free step up in basis. It doesn't require that either couple, either party in the marriage actually be a resident of the state, but it just says if it's community property under applicable state law, And if half of the assets are includable in the estate of the decedent, then the survivor's half of the assets get that income tax-free step-up in basis. And that can save your clients a tremendous amount of money. Now, Alaska did it, and we slavishly followed what Wisconsin had done to adopt its own form of a marital property. It's called the Uniform Marital Property Act, or UMPA. And the IRS has ruled, yes, it becomes community property because Wisconsin passed this law. A couple can elect out, or they can elect in, but you can elect in if you move to California. But with an Alaska Community Property Trust, you can elect into Alaska Community Property, even though neither spouse lives there, provided you have the requirements under Alaska law for an Alaska Community Property Trust. Well, many of my brethren in the United States, including in Tennessee, Kentucky, South Dakota, all said, gee, that's a great deal. Why don't we adopt something like that here? So those states, there are about 5 of them now, which have tried to adopt a community property system by election. I do not think they work, because under the Angerhofer case, which I know all of you will be anxious to read this evening with your loved ones, it basically says that to be community property for federal tax purposes, it's not just calling it community property, it has to have certain attributes. And one of those attributes is that each spouse must be able to dispose of his or her interest in the community property when they want to. So if you have community property in California, as I said, and the husband dies first, the wife can leave her property, her half of the community property, any way she wants, and so can the spouse who's just died. But under Florida law, for example, even though you put it into a Florida community property trust, they claim that, well, you're going to go ahead and basically have it be in the estate because we're saying it's community property. But if they take it out of the trust before death, the spouse who was not the original owner of the property can't control the property. And when you read Angerhofer, which I know many of you will do, Angerhofer, Angerhofer versus Commissioner, 1986 tax court case, you will see that it missed that element. The other spouse was not permitted to dispose of his or her half of the community property once it got out of the trust. And Florida, for example, provides that if it comes out of the trust, it is no longer community property. So I don't think you have community property for federal tax purposes if you do it in one of those states other than Alaska. In Alaska, I think it really works. Now, Marty, what about just trusts?
Let me do this. I'm going to cover this topic very quickly because we got to finish up and we're getting shorter on time. And I know you have some thoughts on it, but I'm going to just cover it just so it's out there. This is another concept that some advisors believe work, others don't, to get a basis step up on all property for a couple that lives in a non-community property state. Now, certainly you can go and do as Jonathan said and create a community property trust in the state that permits it, like Alaska. But this concept is you create a joint revocable trust in a non-community property state. If husband puts assets in, say $5 million, and wife puts assets in $5 million, the idea is that husband's assets, his contribution of half, he will have those included in his estate on 2036, 2038, and get a step up in basis. As to the wife's half of the assets, if husband dies first, the concept is that he's given a general power of appointment over those assets to cause estate inclusion, and vice versa for the wife. So the idea is that those that advocate for this suggest that that should suffice to get full basis step up. There's a number of issues. First, there's a question as to when this general power over the other spouse's assets contributed to the trust over the wife's or hypothetical actually comes into being. The IRS seemed to have said, if I'm reading it correctly into the PLRs, that GPOA only came into being on death, and therefore there was a gift. And then there's an issue, does that gift qualify for a marital deduction because the husband's already passed? There's another question as to whether or not the same asset can be subjected to, let's say, the wife's power to revoke it because it's in a revocable trust, while at the same time having the husband hold a valid GPOA that causes estate inclusion. So this joint estate step-up trust is another concept out there. It's got some issues, and we're going to skip through that and move on.
Let me just mention one thing. The theory is that you create a trust and you get the power to revoke it up until you die. But when you die, your surviving spouse now has a general power of appointment. So it's going to be in your estate when you die because you have a power to revoke under 2036A2 and 2038. And yet it will be in your spouse's estate because he or she now has a general power of appointment. But the problem is, I don't think the power of appointment that you're giving your spouse arises until you die. And there's a serious question about whether or not that can be done. Can you create that for your spouse? And as Marty said, will it qualify for the marital deduction? Because you're now dead. I can't, let's say 2 days after my wife dies, I can't say, well, I'm going to give her assets and I'm going to have them qualify for the marital deduction. Once she's dead, I can't do it. And I think you run a real risk of saying, well, yes, she's died, but the transfer was at the moment of her death, so it still qualifies for the marital deduction. I think that's it. And by the way, if this works, it means you could create one trust and you could go to everybody in your neighborhood and say, hey, if you have less than the amount of the estate tax exemption, I'm going to give you a general power of appointment effective as of my death. So to cause those assets to be includable in your estate when you die. By the way, the law seems pretty clear that you have a general power of appointment causing estate tax inclusion under section 1041, even if you don't know about the general power of appointment. So this means that no one should ever have to pay capital gains tax at death, because you just go around your neighborhood, you find out people who have relatively short life expectancies, they're going to die in a year, in a month, whenever it's going to be, and they're giving them a general power of appointment effective on their deaths, even though they didn't know about it, causing estate tax inclusion for them under section 1041. No estate tax is going to be paid because they're way under the exemption, because you'll have your formula basically saying they only have this general power to the extent that it doesn't cause any estate tax to be due from them. So that's it. But I will tell you, I just can't believe it works, because I can't believe that you can avoid the estate tax by giving someone, as of someone else's death, a general power of appointment.
Let's change gears and go on to another topic. And let me just give an example, which is on the slide. In 2012, we thought the exemption was going from 5 million down to 1 million in 2013, which obviously didn't happen. And now it's 15 million permanent. There were a lot of clients that created spousal lifetime access trusts or other irrevocable trusts in 2012 before the exemption was to decline. It may have put a couple $1 million into it. Not even, the exemption levels we're talking about. No, nowhere near that. And they did it because they wanted to safeguard those assets. Now those assets have appreciated. It's a lot of years since then, and they're not going to get included in the client's estate. If they die, there's no basis step up and there's no estate tax benefit. Bob, do you want to comment on some thoughts? What do you do with some of these old irrevocable trusts, SLAT or otherwise, dynasty trust or otherwise? What can we do to try to get a basis step up? Why don't you go first, and then we'll let Jonathan comment.
Well, just stipulate that we are 100% certain that this client will never be subject to an estate tax, even if a new Congress brings the exemption back down to $5 or $7 million. What we could do, it depends on the provisions of the trust. But Ken, if the trust is for my wife and there's a very broad discretionary power, can we pay that property out to my wife? That may be an option. So we could distribute property to the spouse or other beneficiaries if the standards allow for that. You could, for example, the other thing, if it's a grantor trust, I could put cash in there and take back a building that maybe is fully depreciated so that I own that building when I die. Those are all things for us to think about. Now, we could certainly, maybe we could give my wife a contingent general power of appointment in case she has any room left in her exemption. We have to be careful with that we don't inadvertently create a grantor trust, but we might be able to do that. And then finally, you could decant or reform it in such a way that it would be included back in your estate. So that's kind of the lay of the land, but it's something we have to plan for, because let's say you had $3 million with 500,000 a basis, Marty, you have $2.5 million of a gap. What could that be worth? That might be worth $750,000, $800,000 of value.
It's a lot of money.
It's a lot of
Jonathan,
money.
thoughts, comments?
Yeah, I mean, a couple of things. If in Bob's example, and Bob's wife is the beneficiary of many trusts her parents and grandparents have created for her, and they're big trusts. And Bob says, well, to the extent she has available exemption, we'd like those assets includable in her estate. What can we do? Well, Bob said, well, one, you could invade the trust and give her those assets before she dies. That might be a little dangerous, because maybe, you know, when Bob passes on, or maybe she'll decide to leave Bob and marry the tennis coach or someone like that. So that's a little scary. The alternative is to give her a general power of appointment, and that will cause the property to be in her estate under Section 2041, even if she can only exercise that power with the consent of a non-adverse party. So that does it. Probably the best thing to do is to trigger what's called the Delaware tax trap, which is under Section 1041A3. 1041A3 says, well, if you have a limited power of appointment, which would not cause the assets to be in your estate, if you exercise it in a certain way, we're going to treat it as a general power and cause it to be includable in your estate. And that's much safer, because again, you don't have to give the spouse any real power over it. She's just going to be able to exercise it in a way to cause it to be in her estate without her owning it, or without her new boyfriend having access to it. So that's something that you really should think about doing if you want to get those assets in her estate. And as Bob said, you can probably either move the trust, if you don't have it under the law that governs the trust, or move it to a state where you can grant someone a limited power of appointment, so you can trigger the Delaware tax trap under Section 1041A3.
Jonathan, can you just explain briefly, because we don't have a lot of time, but just give a little more color on how, if the spouse has that LPOA, the limited power, can it be exercised to trigger the Delaware tax trap? What has to be done?
Well, it's got to be done in such a way that she can start a new rule against perpetuities. There's a long history of this. It started in Delaware because the DuPont family didn't want to ever pay any estate tax, and yet common law said a trust could only last for lives and being plus 21 years, and they wanted to go on forever. So they basically said, if you have a trust and you give someone a limited power of appointment, that person can exercise that power, put it in further trust, and they can have a limited power of appointment, and it will never be in their estate. So Congress was not pleased with that, so they modified the general power of appointment provisions under Section 1041 to provide that even if you had a limited power, but if you exercised it in such a way to allow the trust to last longer than a traditional rule against perpetuities, we're going to treat it as a general power, putting it in the estate. There's a lot of interesting things. If you really want to read about this, you can go to the April 1988 issue of the Journal of Taxation for an article by Professor Jeffrey Pennell and me, which discusses how you can use this for getting assets in the estate. So that's one of the things that can be done. It's probably one of the safest. Just make sure you go to the right jurisdiction so you can definitely exercise and trigger the Delaware tax trap.
Let me go on, Bob.
Just to be clear, can I do this in a jurisdiction that has abolished the rule against perpetuities?
Well, Bob, what you can do is, number one, yes, you can. In fact, if you move it to Arizona, Arizona has a special rule that you can trigger the Delaware tax trap, even if you don't give someone some power which would cause it to be in their estate. So that Arizona has a great law on that. But you can move it to Arizona. You'll still get the exemption from estate tax inclusion for estate tax exclusion. but you will not have it in the estate. So yes, you can do it. You can do it in any state if you're careful about it. Just don't think, well, I can just do it here, because if you're in a state which has no rule against perpetuities, you may be blocked. But as the Arizona legislation indicates, you can basically create your own system so as to trigger Section 1041A3.
Jonathan, if I created a trust in New Jersey, right now New Jersey has no rule against perpetuities. But if I created the trust 20 years ago when New Jersey had a rule against perpetuities, isn't it the wrap that existed when the trust was created that governs, so that even though New Jersey has no rule now, it did then? Does that affect what we're doing?
Well, Marty, you're a New Jersey practitioner and you answer that question, but I think the answer is yes, that is
Yes.
correct.
So just because the state doesn't have a rule against perpetuities, look at when the trust was created and what state law was then.
Or again, you can go ahead and you can put it in a jurisdiction where you're going to be able to trigger the trap. Very, very powerful.
Let me make a couple of comments and then we'll move on. First of all, one of the things that's going to happen, some clients are just going to gut a trust, take the money out, not care about what the terms of the trust are. That's really not prudent. Before you do that, before they do that, they should really evaluate Medicaid planning, elder law issues, asset protection, claims, divorce. Gutting a trust needs to be done thoughtfully. The trustees need to be careful, because if they gut a trust and somebody gets sued the week after that, it's going to be a disaster. So a lot of clients are just going to do self-help, and that could really be bad. I think this is another, just like I've said earlier, great opportunity for both accountants and for wealth advisors to identify planning opportunities. If you are investing money that's held in any kind of irrevocable trust like a SLAT, when's the last time the client sat down with their team and evaluated, does this trust make any sense? Should this be what we're doing? And accountants that are preparing those 1041s, even if it's a grant or trust return, ask the question, when has this plan been looked at? I see the trust was set up 10 years ago. Does this still make sense? And in a lot of cases, for all the reasons we've just gone through, it may not, but it should be thoughtful and deliberate what's done. There are over 2 million existing credit shelter trusts, if I got the data right. It's a lot of trusts. Many of those credit shelter trusts were established when the exemption was way different. And unless there's a state estate tax that justifies doing the credit shelter trust, there may be no federal or state death tax savings, just no step up in basis. Those trusts should really be evaluated. There's a lot of them. We've covered a lot of different techniques, but Jonathan, maybe you want to talk about non-judicial modifications and what that might be able to do to help address these basis issues.
Well, depending upon state law, you may be able to do a modification. It depends upon state law. Diana Zadel has written a very careful, thoughtful, and informative article for the Notre Dame Estate and Tax Planning Institute a couple of years ago, and it would be worthwhile to get that. But she talks about the different ways in which you can change the terms of the trust, either by granting powers of appointment, by doing a non-judicial modification, such as a so-called decanting is one of the ways to do it. A decanting is where you pour the assets of one trust into another or a new trust, typically, basically having better terms either for asset protection or for tax purposes. That's a concept which I think I can take the credit for developing, and it's very, very important, and the vast majority of states now have it. So that's something that you really need to look at.
There's lots of ways to skin the proverbial cat. And if you have a trust that's not serving the client's purposes today, look at how you can change it. But again, as we've said several times, look holistically, consider creditor protection issues, consider potential change for an estate tax in the future. Maybe there's something like a swap you can do to still maintain the trust, but get the assets back into somebody's estate so that you don't have a problem if the exemption is reduced in the future. We've talked about downstream planning. Bob, Jonathan, would one of you like to explain upstream planning? Because that's certainly something for new trusts especially that should be thought about, and maybe it's possible to modify an existing trust.
Well, I can take this on with the senior, because I've had clients come to me on this, and one example is a gentleman, his aunt is 95 and a half years old, and he has all this low basis property. And the thinking is he'll drop that low basis property into a trust for his aunt. She'll have a legitimate income right to HEMS, basically income based on a totally discretionary, not HEMS standard, and his children and grandchildren. And what we're going to do is give his aunt a general power of appointment over the property. And at her death, everybody believes that that will be included in her estate and she'll receive a step up in basis. So that's a very interesting technique. The question becomes, how little right can she have? I think, Jonathan, if we just gave her a naked general power appointment, that's harder to get a step up than if she has some type of discretionary right during her lifetime. Or can you talk to that?
Well, we don't know, Bob. The case law has basically developed that if you have a general power of appointment, even if you didn't know about it, even if you inadvertently exercise that power, it's nonetheless a general power of appointment causing estate tax inclusion. What I think the courts may do is to say that the power given to the aunt may really be illusory. So, Bob, I think you're right. If you want it respected that she really has this general power of appointment, you really need to make her a beneficiary of the trust. Now, they might still say this is purely nonsense. You didn't really intend her to have a general power. You knew she wasn't going to exercise it, and maybe there's an explicit or an implied agreement. But certainly if she doesn't know about it, and the power says it can only be exercised with the consent of someone who's adverse, I think there's a really serious question as to whether or not it would be respected that she had a general power of appointment. But on the face of it, Bob, as you stated, it looks like it's going to be in her estate, even if it's the only interest in she has, and it is this general power, which she can exercise only with the consent of a non-adverse party, like the lawyer who put this all together. And in theory, that works. Now, again, I think there will be ultimate litigation. And keep in mind that this cannot work for super wealthy people like Bob and Marty. The reason is that Marty or Bob is going to have to make a pretty big gift. They're going to have to give the aunt in the example Bob was giving. They're going to have to give her a property right over it, which means that the nephew who's created this for his aunt is going to have made a gift. Now, again, if he's super wealthy and it's a lot of money, like 5 or 10 million, that's going to eat up his exemption, which may not be acceptable. So you've got to have people who are not likely to be over the estate tax exemption when they die, because you don't want them to have used up their exemption by giving this general power to their maiden aunt who won't really know about it. So I think you really need to think it through, certainly for the kind of wealthy people that Bob and Marty want to represent, and people who are wealthy like Bob and Marty, it's not a technique that will work.
Let me make a couple of comments quick because we're going to wrap up in 10 minutes, no more than 10 minutes. I agree with what Bob and Jonathan said, that the appearance is that under current law, you can give a mere naked power with no notice, no knowledge, and it works. That being said, if you have the ability to make the aunt in these hypotheticals a beneficiary, if you have the ability to make some discretionary distributions to that aunt, why not do that? If you can send the aunt a copy of the trust agreement certified mail so you have confirmation and proof to corroborate that she got the copy of the trust, why not do that? There's steps that can be.
Marty, then you run the risk that she will exercise it in favor of her friends, her favorite charity, her kids.
It depends how circumscribed it is, and you need the lawyer's approval. The point is, I think it's worth of a discussion with the client. Can we go further to make this more substantive and more real than just a mere naked power with the aunt not being a beneficiary? And that's for another day, but we've given you some thoughts on that. Another tool for your post-OBBBA basis planning toolkit. Final point, which is very important. Why is upstream planning different post-OBBBA than pre-OBBBA. Pre-OBBBA, until just recently when OBBBA was enacted, we had on the books a law that said the exemption was being cut by half. And one of the worries that I had when we were doing upstream planning is, oh, what happens if the exemption is cut in half and now somebody has a power of appointment that's greater than what their estate tax exemption is? Well, in that case, you would have drafted perhaps with a formula to constrain that, but you still had the concern that the basis step up by inclusion could be limited if the exemption was cut in half. Well, now we have a $15 million permanent exemption, so the opportunity, and again, until it's changed, the certainty maybe of a larger amount that we can use for that purpose. So we're pretty much out of time. We've covered what I think are a lot of different planning concepts. Jonathan gave an overview of why basis is important, how it's calculated. We talked about upstream planning, downstream planning. We talked about swapping assets. We talked about changing a trust to cause estate inclusion. Jonathan, do you want to make some final comments, and then we'll give it to Bob to close?
I'm handing it to Bob right now.
Marty, I think it's just, for most of the listeners, spend a little bit of time on OBBBA, be able to convey to your clients how shifting property into trust could potentially save state income tax, potentially increase your SALT deduction, increase your 199 Cap A deduction, allow you to stack up property for QSBS. So those are all going to be very important things, because I think as there's less estate tax planning, the shift is going to be on using trusts for income tax planning. So there'll be a total renaissance in the use of non-grantor trusts.
But as we discussed, and Bob led the charge on this, when you set up a non-grantor trust, pause and think about, should this be a completed gift trust or an incomplete gift trust? Can you make it an incomplete gift trust? What are the implications of complete versus incomplete on state income tax consequences? New York and Florida, for example, an incomplete gift trust that's non-grantor will not be respected, so you're going to still pay state income tax. That may be a palatable result if you're getting a good income tax result on a federal level like 199A, et cetera. So there's a lot of different variations here, and I think it's important for practitioners of all disciplines to be able to issue spot issues and identify planning considerations or options that many of us had not focused on in the past. And again, it's a broader range of wealth and income levels that can benefit from this. It's not only the super wealthy. We got to change the conversation. Clients should not go to an estate planning attorney because they're worried about being over the exemption. If they have any potential for income tax planning, non-grantor trust, incomplete gift, all that should be on the table.
Marty, let me say one other thing. It's been indicated here that if you have a completed gift trust and the assets are not going to be in your estate, you just use $1 million or even your entire 15 million and you put it in trust, that it's not going to be in your estate when you die, and therefore it's not going to get the tax-free step-up in basis. Well, there are a number of things that possibly could be done, including having someone give the grantor a power of appointment. If you read that Rivlin-Blottmacher article that was in estate planning on searching for basis in estate planning, you'll see some techniques. But Mitchell Gans and I came up with a notion that even if you've made a completed transfer, nonetheless, the assets may be entitled to an income tax-free step-up in basis at death, even if they're not in the estate. Now, that's a broad topic. I know that sounds contradictory because everybody knows from the time they were a Girl Scout that in order to get assets to have that tax-free step-up in basis, you want to have it in their gross estate. But Mitchell and I believe that the law says even if it's not in their estate, it nonetheless will be entitled to that income tax-free step-up in basis. You want to take a look at Revenue Ruling 2003-2 and the article that Mitchell and I wrote in the September 2003 issue of the Journal of Taxation about that. And we believe that although it doesn't make any sense from a policy perspective, it appears that even though the assets will not be in your estate, nonetheless, you can, if it's a grantor trust when you die, you nonetheless are entitled to an income tax-free step-up in basis.
And if you want more on that, there's at least an hour long, if not longer, webinar. I think it was Jonathan, you, me, and Mitchell. I don't remember if we had somebody else on it about
No, I think
revenue
it was the three of us, Marty.
on revenue ruling 2023-2. That goes into some considerable detail on that, and obviously the article Jonathan mentioned will be helpful. Good luck, everybody. It's certainly a lot of new planning ideas and a different planning paradigm than what we've had before, and hopefully we've given you some insights to help your clients better. Thank you for joining us, and thank you to Bob Keebler and Jonathan Blattmacher for all their insights and help. Take care, everybody.